Welcome back to the AlgoBot channel, where we break down automated trading strategies for MetaTrader 5, one expert advisor at a time. I'm AlgoBot, and today we're studying a strategy called Zero-Lag Trend Reclaim. It's a trend-following pullback approach built around the zero-lag exponential moving average, a smarter and more responsive baseline than a standard moving average. By the end of this video, you'll understand how it defines a trend, how it waits for price to dip and then reclaim that baseline, and how it manages risk with tight stops and an early break-even lock. This is educational content only. Let's dive in. So what exactly does the Zero-Lag Trend Reclaim Expert Advisor do? At its heart, it's a trend-following system that tries to join an existing move on a pullback rather than chasing a fresh breakout. The single tool driving every decision is the zero-lag exponential moving average, often shortened to ZLEMA. A regular moving average always lags behind price because it's an average of the past. ZLEMA, developed from the work of John Ehlers and Patrick Malloy, tries to cancel most of that lag using an error correction term. Instead of smoothing raw closing prices, it smooths a delagged input, which is twice the current close minus the close from a few bars ago. The result is a baseline that hugs the trend more closely while still filtering out the choppy noise of raw price. The strategy is time frame agnostic, meaning it runs on whatever chart period you attach it to. In the source notes, it's described as working well on a trending currency major or a metal, such as euro, dollar, or gold, on the 1-hour chart, but nothing in the code locks it to those. It computes both the zero-lag baseline and the average true range by hand from raw candle data, so it doesn't depend on any external indicator library. Who is this style suited for, from an educational standpoint? It's aimed at traders who are interested in disciplined, rules-based trend following, people who want a clear, mechanical definition of when a trend exists and when to stand aside. It only trades in the direction of the measured trend. It takes one position at a time, and it never stacks exposure. It's built around the idea of small, controlled risk per trade, with a strict filter that rejects setups whose stop would sit too far away. Remember, though, that trading always involves risk, and losses are a normal part of any strategy. Nothing here is a promise of results. It's simply a study of how the logic is constructed. Let's walk through the mechanics step by step. Everything begins with the regime filter, which decides whether a trend even exists. The EA measures how far the zero-lag baseline has risen or fallen over a look-back window, for bars by default, and then divides that change by the average true range. This turns the slope into a volatility normalized number, so it means the same thing whether the market is quiet or active. If that normalized slope is greater than or equal to the slope threshold, which defaults to 0.3, the EA considers the market to be in an up regime and will only look for long trades. If it's less than or equal to negative 0.3, it's a down regime, and it will only look for shorts. Anything in between is treated as flat or ambiguous, and the strategy simply stands aside. Now the entry. In an up regime, the EA waits for a specific sequence. First, the prior bar must have closed at or below the baseline. That's the dip. Second, the recent pullback window must have genuinely pierced below the line, confirming price actually pulled back. Third, the just closed bar must close back above the baseline with a bullish body. That's the reclaim. And fourth, the reclaim must not be overextended. The close has to be within one average true range of the line, so the entry hugs the baseline. When all four conditions line up, the EA signals a buy. The short side is a mirror image. In a down regime, price pops back above the line. Then the latest bar closes back below it with a bearish body near the baseline, and the EA signals a sell. Risk management is where the low drawdown design lives. The stop loss is placed just beyond the pullback extreme, the low of the pullback for a long, the high for a short, buffered by a fraction of ATR. Because the entry sits right next to the baseline, that stop is naturally tight. If the required stop distance would exceed the maximum risk cap, 2.5 ATR by default, the setup is rejected outright. The take profit is set at a multiple of that stop distance, the reward ratio, defaulting to 2.2. Finally, once price moves 80% of the initial risk in the trade's favor, the stop is pulled up to the entry price. From that point, a winning trade can no longer turn into a loss at its stop. Only one position is ever held at a time. Let's look at the actual MetaQuotes language code that runs inside MetaTrader 5. At the top are the input parameters you can adjust in the strategy tester. ZlemaPeriod sets the length of the zero-lag baseline, 34 by default. SlopeThreshold and SlopeThreshold define how the trend is measured and how strong it must be. ATR-period scales everything to volatility. Pullback bars sets how many recent bars form the pullback window that anchors the stop. Stop buffer ATR, max risk ATR, reward ratio, and break-even R shape the risk model. Below the inputs are the two signal blocks. The long block fires when trend up is true, the previous close sat at or below the baseline. The pullback low pierced below it, and the current bar closed back above the line with a bullish body that isn't overextended. When that's all true, the code reads the ask price, sets the stop just below the pullback low minus the buffer, checks the risk is within the cap, computes the take profit from the reward ratio, and calls place with an order type of buy, which sends a trade.buy under the hood. The short block is the exact mirror. When trend down is true, the previous close sat at or above the baseline. The pullback high poked above it, and the current bar closed back below the line with a bearish body near the baseline. The code reads the bid price, sets the stop just above the pullback high plus the buffer, and calls place with an order type of sell, which sends a trade.sell. Both sides store the original risk so the break-even logic can track it later. Clean, symmetrical, and fully rules-based. Now let's bring it all together on a chart. The blue line running through these candles is the zero-lag baseline. Think of it as the strategy's trend anchor. Watch how it responds quickly to price while still smoothing out the noise. We're going to follow two complete trades, first a long, then a short. Look at the first few candles on the left. Price is grinding higher, and the blue baseline is sloping upward beneath it. That rising slope is the first thing the strategy checks. Measured over the look-back window and divided by the average true range, this slope clears the threshold of 0.3, so the market is officially in an up regime. From here, the EA is only interested in buying dips. It will ignore any short ideas entirely. On the third candle, price pulls back. This candle dips down and closes right at the baseline. Its low actually piercing just below the blue line. That's exactly the dip the strategy is waiting for, price stretching back toward its trend anchor inside a healthy uptrend. Notice it's a shallow pullback, not a collapse. Then comes the reclaim. The very next candle opens near the line and closes firmly back above it with a solid bullish body. And importantly, it closes within one average true range of the baseline. So the entry isn't chasing an overextended move. All four long conditions are now satisfied, and the buy entry marker appears. The EA buys at the ask and places its stop just below the low of that pullback, buffered by a fraction of ATR. Because the entry sits right next to the baseline, that stop is tight. The distance from the entry to the stop is our 1 unit of risk. Watch what happens next. The following candles push higher, riding the baseline upward. As price runs about 80% of that risk distance in our favor, the stop quietly slides up to the entry price. The break-even lock engages, and the trade can no longer turn into a loss at its stop. Price keeps climbing, and by the fifth candle it reaches the take-profit target, set at 2.2 times the initial risk. The take-profit marker prints, and the long trade closes for a completed move. That's the whole idea. Enter near the anchor, risk little, and aim for a larger multiple. Now the market shifts. Look at the middle of the chart. Price stalls, rolls over, and the blue baseline flattens and begins to slope downward. Once that normalized slope drops to negative 0.3 or below, the regime flips. The strategy is now in a down regime and will only look for shorts. Here's the mirror image of what we just saw. Price bounces back up into the baseline, a counter-trend pop that the source calls a rip. On this candle, the high pokes above the blue line, and the prior bar had closed at or above it. Then the next candle closes back below the baseline with a bearish body, near the line rather than far from it. That's the reclaim to the downside, and the sell entry marker appears. The EA sells at the bid and sets its stop just above the high of that pullback, buffered by ATR. Again, a tight, structural stop. From there, price rolls over and works lower, candle after candle. The break-even lock arms once the move runs far enough in favor, and price continues down until it reaches the take-profit target, again set at the reward multiple of the stop distance. The second take-profit marker prints, and the short trade is complete. 2 trades, 1 simple template. Define the trend with the zero-lag baseline. Wait for a shallow pullback and a confirmed reclaim. Enter right next to the line for a tight stop. Protect the position at break-even, and aim for a larger reward multiple. And remember, not every setup reaches its target. Losses are part of the process, and this is an illustration of the logic, not a prediction. And that brings us to the end of our breakdown of the zero-lag trend reclaim expert advisor. Today we saw how it uses the zero-lag exponential moving average to define a trend, how it waits for a shallow pullback and a confirmed reclaim of that baseline to signal an entry, and how it manages risk with a tight structural stop, an early break-even lock, and a reward target set as a multiple of that risk. Everything we covered is educational content only, and nothing in this video is financial advice, a recommendation, or a solicitation to trade. If you found this analysis helpful, please like the video, leave a comment with the strategy you'd like us to study next, and subscribe for more MetaTrader 5 strategy breakdowns. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.